The stock market or the housing market, which is riskier?
Coming from an investment banking background, we've chosen to move quite a bit over into actual real estate assets.
Today we're looking at 5 myths of investing in the housing market, and this applies whether that investment is your personal home or solely an investment property. Since the 2008 real estate market crash and the pandemic boom, a lot of Americans have come to the conclusion that real estate is a risky investment with a lot of volatility. This week I had the pleasure of interviewing former investment banker, CPA and Realtor Kendall Harris. Lucky for me and for you too, Kendall also happens to be one of my buyer's agents. Myth number 1, the real estate market is volatile. Since the 2008 crash, people are afraid. They're afraid that they'll buy a home and it'll lose value and then they'll be stuck with it, never able to sell it. Being upside down on a house is a different kind of problem than taking a loss on your 401k, and both of those things actually happened to a lot of people in 2008, so I can totally understand the fear. I mean, if the stock market crashes, on one hand, it's just numbers on a screen, at least until you're retired. Most people don't need to access their stock account regularly. But it's one thing to lose money, it's another to suddenly be in more debt than you anticipated. So stock losses don't seem to have as broad of an impact as a housing market crash. But even at that, the fears in most people's cases are not justified.
Looking back to 2008 and the few years subsequent, you can see that the Dow Jones, which is essentially an index that gauges the value of the U.S. stock market as a whole, it lost a full 50% of its value almost instantaneously with the real estate market crash. So a tremendous loss. That's why you heard all those horrible stories about people's life savings and people's retirement funds taking such a huge hit. Now, the real estate market in the triangle in the exact same period of time went from an average sales price pre-crash of around 256 to around 208 at its absolute lowest. So whereas the Dow Jones, the stock market lost a full 50% of its value, the real estate markets on average lost less than 25%. The real estate market was far more insulated against the shocks of the economic crisis we had than the actual stock market itself.
The best thing that you can do to protect yourself against potential job loss is not to forego buying a house. It's to have a good emergency fund. If you lose your job, you can't pay the rent any more than you can pay the mortgage. Myth number 2, the stock market offers similar returns on your investment as the real estate market. This one for me was a mind blower. I actually used to think that the housing market and the stock market offered similar returns, but it was because I never really thought about how these two investments differed at their core. And this is how you can fall into little fallacies that cause you to make huge mistakes in your financial planning. You know that you want to leverage your investments as much as possible, but what does that really mean?
So leverage is a measure of how much you can amplify your initial investment into returns that you get to keep, that you get to walk away from the deal with. And in real estate, we're given a kind of phenomenal situation where, again, leveraging mortgage loans, we can invest a small down payment, typically about 20%, and acquire an asset and become the owners of that asset. But we are earning the gains and the returns on the full asset value, not on just the smaller 20% portion that we invested. A quick example, if you put down 20% of your own funds on a $300,000 home, you've invested $60,000, you now have attached to your name a $300,000 asset, and your earnings are going to be based off of that $300,000 asset. So in 5 years, let's say it gains value of about 5% a year, which is pretty reasonable. That $300,000 home is going to be worth about $380,000, $382,000. And if you'd like to then, let's just discount selling costs, anything like that, you can sell your home and pay off your loan and walk away with about 142 grand to your name, all off of your initial 60% investment. So that's well over 100% return on the initial funds that you put forward. Now, on the flip side, on the stock market, you typically don't have that same opportunity. If you have that same $60,000 and you buy a portfolio, you buy equities, you buy any kind of financial instrument, what you receive is $60,000 of asset. And over time, the growth you receive is tied back to that $60,000 of asset. There's not that same concept of paying a little to get a lot and getting to cash in on the growth of that bigger amount. And it's worth saying that The stock market does offer some more advanced trading strategies like trading a margin or leveraging calls and put options and things like that to introduce the concept of leverage into the stock market. But you really need to know what you're doing. That's not an area that you want to dabble in if you don't understand how those instruments work. So a lot more complexity and nuance is required if you want to try to recreate that same leverage concept in the stock market.
Myth number 3, real estate isn't a good investment because your funds aren't liquid. Sometimes you need the cash out of your investment. Maybe it's for a medical emergency, maybe it's college tuition. Stocks are obviously much more liquid than a piece of real estate. It's true that you can sell a stock in a day and get your money out and put it toward other needs. But there's one thing you can do with your real estate investment that can make it almost as convenient so you can still take advantage of the leverage and the less volatile investment.
HELOCs and home refinances and home equity loans are excellent tools. Essentially, what they allow you to do is access the equity that you built up in your home. So the difference between what you owe in your home and what would currently sell for on the market, and pull that out as cash. Now, when you access liquidity this way, of course, it's treated more or less like a loan or like a line of credit. So you're paying interest on those funds while they're outstanding. But it does solve that timing challenge of wanting to get quicker access to the money that you have tied up into your real estate investments.
The upside to paying the interest on a HELOC is that you get to keep the asset. Once you sell a stock, it's no longer earning you income. If you own a real estate investment and leverage the equity with a HELOC, you'll continue to own that property and it's going to continue to grow in value over time. There are ups and downs, of course, but historically, real estate has always gone up over time. Myth number 4, fees associated with buying and selling real estate are much higher than fees associated with buying and selling stock. All right, just keeping it real here. If you've sold a house before, you probably choked when you found out how much it was going to cost you to sell that house. A lot of people believe that those fees that you pay when you sell your home are astronomically high and eat up a lot of equity in your home when you sell. How do realtor fees stack up against the fees you pay to your stockbroker?
If you sell a $500,000 investment property and you are paying an agent around 6% to dispose of that, that's $25,000. On the flip side, before we're talking about a $500,000 investment property, now let's talk about a $500,000 stock portfolio. The most notable expense that you'll be hit with is a portfolio manager or an investment advisor. They generally charge, of course it varies, but around 1% of the assets under management and commission each year. So that $500,000 investment portfolio is going to cost you about $5,000 a year to have managed. Now, in year 1, yes, it costs less to have an investment portfolio than it would be to pay an agent commission to sell your investment property. At year 6, they're equal. And assuming you hold that money for longer than 6 years, every single additional year, it's cost you $5,000 more in expenses to sustain that assets on the stock market side than the asset on the real estate side.
And now, tax advantages. If all of those things didn't convince you to think differently about the housing market, here's one last tip if you decide to buy a second property as an investment. While there are costs associated with owning and maintaining an investment property, as long as the property is a true investment, all of these expenses are tax deductible.
A major advantage that real estate has over investments in the stock market is that the tax law sees real estate investing as a business, and thus there are multiple opportunities for you to deduct what they consider business expenses from those revenues to lower your taxable amount. So when you are holding an investment property, things like property management fees, repair and upkeep, advertising, marketing, even the commission you're paying to your agent to ultimately sell and dispose of the property, those are all considered business expenses because they're necessary and ordinary expenses required to keep your business running, your business being your investment property. And the ability to deduct those from your taxes is tremendous.
I'm expecting someone to comment below that all I'm trying to do is get people to buy houses. Of course, everyone's situation is unique, but over time, real estate investments have been the best investments I have ever made. So did this change your opinion or perspective of the benefits of purchasing real estate?
Through living and learning in the real estate world, we've chosen to move quite a bit over into actual real estate assets because we just see it as a better long-term way to protect and grow the money.
If you like this video, you might also like this one where I talk about the shifting market in Raleigh.